Like everybody done here? So see, the directors of AFCO, a public limited company, are reviewing the financial statement of two entities which are acquisition targets, Kevor, and Leiden. They have asked for clarification on the treatment of the following financial instruments within the financial statement of the entities. Ben, there is one that has told you what they are. Financial instruments. Okay. Kevor has two classes of shares, A and B shares. A shares are covered ordinary shares and are correctly classified as equity. Okay. If it is correctly classified, we don't have any problem. So the concern is now the B. B shares are not mandatorily redeemable shares, but contain a call option allowing Kevor to repurchase them. Listen, it is not a mandatorily redeemable shares, but it's a share anyway, so the company can repurchase it back at their option. Dividends are payable on the B shares as if only, if only dividends are paid on the A shares. I don't know if you got the idea. So we will pay dividend on the B shares once we pay dividend on the A shares. Let's go. The terms of the B shares are such that dividends are payable at a rate equal to that of the A shares. If B is the same as A, then B is also like equity. So as at this time, I know that it should be treated as equity. But let's continue. Additionally, Kevor has also issued share option which give the counterpart rights to buy a fixed number of its B shares for a fixed amount of $10 million. The contract can be settled only by the issuance of shares for cash by Kevor. What do we treat this as? So the first thing is the B shares. Simple. Now the nature of the explanation of the B shares signifies that, you see, you can only recognize a financial liability when there is a contractual responsibility to redeem or to pay any interest. But if you look at the B shares, we will pay dividend when we pay for A. We will pay dividend in the same proportion that we paid for A. If that is the case, then B shares should be treated as what? An equity instrument. That's the thing. Except that the B shares, we pay dividend in B shares as A. The ratio of the dividend paid as at B is the same as what is paid at what? A. So if that is the case, then the share, the B shares, the A has been rightly classified as equity, and the B also equity instruments.
What is the essence of this question? What is he testing?
He's testing your understanding of classification of financial instruments into equity and liability. So the first thing is about equity. Then the second one is about share-based, whatever. Additional Kevor issue share option which give the counterpart right to buy. So when you give somebody right to buy, they have the right to buy. How do you clarify that? It's a share. If it's a share, it's a share. So equity instrument. You know that. So the Kevor transaction, you treat both of them as what? Equity instruments. Yeah? Maybe? That's all the examiner wants to hear. Leiden. Leiden. Leiden has in issue two classes of shares, share A and B. A shares are correctly classified as equity. 2 million B shares of nominal value each are in issue. The B shares are redeemable in 2 years' time. Listen, they are redeemable in 2 years' time at the option of Leiden. Leiden has a right as to the method of redemption of the B shares. It may either redeem the shares for cash at the nominal value or may issue 1 million shares in their settlement. A share are currently valued at $10 per share. The lowest price for Leiden's A share since its formation has been $5 per share. So what is it here? So this is where Elvis said it is a compound financial instrument, in that we need to recognize the financial liability and financial assets. So in this case, Yes, when you write a financial instrument, compound financial instrument, yes, you are correct, it could be marked. But in actual sense, this is a financial liability. Why is there a financial liability? Because there is a contractual obligation that we need to redeem the shares in what? 2 years. And upon redemption, you are not the one to decide what the people will take. You can decide to give them shares, they will say they are not interested in shares, they are interested in money. So this is a financial liability. Because of the financial obligation, contractual obligation. So that's all. These are the things you are supposed to write. Maybe 4 marks. So A, both shares must be classified as equity instruments because there is no contractual obligations. Lending has to be classified as financial assets due to the financial obligation.
You said it's supposed to be classified as financial assets.
Did I say asset? Sorry, equity. It can't be an asset. That's a share.
Yeah, but
The second one, you said it should be classified as a financial what?
Liability.
Liability. What's the difference between financial liability and financial assets?
Oh, assets, are they not different things? Assets is different from liability.
But sometimes I read a question. It's the same as though like it's about shares and everything.
you're talking about equity and shares, so not assets and liability. That's what you're talking about. Equity and assets.
You said liability and
No, she wants equity and asset, they're different. Or liability.
no, equity is the same as assets. Anytime there is financial instruments, I told you there are two sides. There is equity and then liability. So what's your question now?
So equity instruments is the same as financial assets.
Yeah. Yeah. At the end of the day, it's an asset to the company because you know asset is equal to what? Equity plus liability, right? So we could say that. I will end on D. Okay, I will end on D for today. So on Saturday when we meet, because
there was a question, 2015 FR question under financial instruments. It talks about these financial instruments. Very simple question, but I don't know. I've forgotten the questions. November.
okay, maybe so you can get it. You can get it, then we see how the treatment is then we consider. Let's go to D. I will end on that one, okay? So that on Saturday I'll touch on the rest of the things. I think one of the reasons is because we didn't start early and the rain. So I'll just end on this. So let's go to Keson. Keson constructs retail vehicle outlets and enters into contract with customers to construct buildings on their land. The contract has standard terms which include penalties payable by Keson if contract is delayed or payable by the customer if Keson cannot gain access to the construction site. Due to poor weather, one of the projects was delayed. As a result, Keson faced additional costs and contractual penalties. As Keson could not gain access to the construction site, the directors decided to make a counterclaim against the customer for the penalties and additional costs which Keson faced. Keson felt that because claims had been made against the customer, the additional costs and penalties should not be included in contract costs but shown as contingent liability. Do you agree to that? Keson has assessed the legal basis of the claim and feel it has enforceable right.
Something is telling me this question of God.
Something there is too
Hey,
hard.
Charlie.
Too hard.
Hey,
No, it's
The question is too hard.
it's too
I
hard.
see your brains drop high.
This is the first time they're going to assess that IFRS 15 and you come and put this big thing in front of me. How? I can give me the give me the 5 steps. That's 5 easy one and right.
That's for level 2. You are too old for that.
I level 2 to IFRS 15.
Yeah,
Okay,
the first
we'll bring that one.
the first time. Okay, so what do you think? What's happening here? Now let's try to reason with the question. 1. Kson is a company that constructs on people's land. Now, if Kson is not able to meet deadline, they pay penalties. Are you getting it? But then if they can also get access to the land, the person who they are constructing the thing for will pay them some money. Up until where we read, Kson has met a deadline. Sorry, yes, has not met the deadline, so they are supposed to pay what? A penalty. But in return, that customer who they claim they have to pay penalty to, that customer also didn't give them access. So it is called counterclaim. Legal file about what? That access claim from the customer. That's what we have heard so far about the story. So they are supposed to receive a penalty due to the access, and they are supposed to receive what? A penalty for not meeting what? The deadline. In the year ended 28th February 2017, Kson incurred general and administrative costs of 10 million and costs relating to wasted material of 5 million. Additionally, during the year, Kson agreed to construct a storage facility on the same customer's land for 7 million at a cost of 5 million. The parties agreed to modify the contract to include the construction of the storage facility, which was completed during the current year. All of the additional costs related to the above were capitalized as assets in the financial statement. What do you think? According to IFRS 15, revenue from contract with customers, anytime there is a modification of the contract, you realize that there is an additional work that they are doing, building of what? Storage facility. This storage facility was not part of the contract. This was the new thing. So the modification of contract results in a new work that has to be done, a new performance obligation that has to be what? Undertaken. As such, what we do is that the 7 million, which is how much we are charging them for, will be added to consideration received from the customer. Okay, that's extra revenue. But have we done the work? We've not done the work yet. So we'll be adding it to a consideration. That's 7 million. Then the cost they incurred, the 10 million and then the 50 million, which they have capitalized, they are not supposed to capitalize it. Why? Because it is a cost they incurred during carrying out of the work. So that 15 million should have been taken to P&L and not capitalized. Maybe any question?
Sure.
Got it.
Touch on the top.
Yeah.
This one.
Yeah. Yes.
Where there is the counter claim, how should you put it? Because the things it gives
Where is the
you
counter
value.
claim?
It says one, how to account for the penalties, how to account for the counter claim and additional costs.
Sure.
How much is the counter claim?
They didn't tell us.
How much is the penalties?
They didn't tell us.
How much? What is the additional cost? That's given to us. So they didn't tell you. So how do you account for it?
So what do you say?
You leave it like that, since there is nothing there to talk about.
Well, can you write something?
Everything.
Let's solve it again, sure.
Show me an he'll start from the scratch.
It's too short, too simple.
It's like I was listening.
There's a major group. Okay. And the opinion is very complex to be true for you. So what I'm saying here is that according to IFRS 12, you are supposed to use the 5 framework to organize what? To recognize. But if you look at this, the modification is okay. Is it okay now?
No.
Okay, so look at it. Look at it. One. So let's identify the items. Go to this place. The additional costs and penalties should not be included in contract costs, but shown as contingent liabilities. So they are owing us, we are owing them. Right. So like let's say there are no figures there, but if you want to write anything on them, on the penalties that is payable, since it is payable, that means that we have to put that into contingent liability. They've already done that. We don't have a problem. Then what we are supposed to claim from them is under the contract. So once they don't give us access, we are supposed to claim it. That is also in contingent liability. We don't have problem about that.
I wrote this contingent liability provision for contingent liability.
Oh, okay, but you didn't put it.
So what you want to receive is from them. Are you going to treat it as a receivable as part of your revenue?
No. What? Which one? Which one are you talking about?
Because they didn't give us access, we have to also charge them penalty.
Yeah, so that one you receive will be a contingent asset. Are you getting it?
Okay.
Then the one that is payable will be contingent what? Liability. But we can net it off. Because if we net it off, we are told that Kingston feel that blah blah blah. Additional cost and penalty should not be the legal basis. Yeah, so if you want to separate it, you can separate it because we can't net it off. But you know that anytime what you are going to be paying will be a contingent liability because it depends on the circumstance. And what you are going to be receiving also depends on what? A circumstance. So contingent liability, contingent asset for the penalty and then what? The claim. Now the chunk aspect of the question is the modification. We modified the contract and included that we will construct what? A storage facility on the same land of the customer, charging the customer how much? $7 million. So this $7 million will be added to total consideration receivable from the customer. The $7 million will be added to total consideration receivable from the customer because this is a new job, true or false? Are you getting the idea? Will be added to the customer. Then the total cost we incurred during the year about general and administration costs and wastage material, those things should be written off in the P&L. Why should they be capitalized? How do you capitalize general expenses? Are you getting the idea? So that's it. The modification, the new performance obligation coming on board is the storage facility. So that storage facility, you add, there's a new income that is coming, 7 million. So you add it to the consideration receivable from the customer. Then the 50 million they incurred during the year should be written off in profit or loss. That's it. Sounds good?
So for the 50 million, the 50 million, we don't know the revenue they are getting for the 50 million.
No, the 50 million relates to costs they are incurring during the year in relation to what they are doing.
So the additional cost should also go and add up. 5 million should also go and add up.
Which 5 million?
Okay, so
This is another 5.
No, the 5 million is the cost we will be
The
incurring.
new cost.
We will be incurring, but we won't treat that. Are you getting the
the
idea?
year ended 28 February 2017. Council incurred general and administrative cost of 10 million and cost relating to wasted materials of 5 million.
Why do you capitalize
That
that?
one is expense.
It should be expense straight up
That's the
to
15
grow profit or loss. When you add those two figures.
And you are saying that the other 5 million will not use it.
Which 5 million?
You said additional.
Yes.
Just put it down.
Why?
We'll give you some more money.
Hey, we are coming to start a PSA. You are going.
Tomorrow you have forgotten to be writing there.
So you want to go? You won't do the PSA. So you want to do? You don't want to do the PSA discussion?
What do we do? Because we are here and we are not doing it.
I'll be starting in the next 5 minutes. I'll be starting in the next 5 minutes.
Yes, madam.
Look at this one. Additionally, during the year, Casson agreed to contract a storage facility on the same customer's land for 7 million at a cost of 5 million. That
We are making a profit.
Why do you make profits? You just add the 7 million to consideration receivable from the customer. The 5 million is a stand-alone cost of that thing. What allocation? You don't do any allocation. So the only thing you do is add the 7 million to consideration receivable from the customer because there is a new performance obligation. Treat the 50 million to profit or loss account and that is all. That's all you have to do.
As for the 5 million extra costs, you don't touch.
We are not, yes, we're not going to do that.
So that is what you got currently.
Charlie.
Because I was thinking the cousin is the contractor.